Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, January 2nd, and the markets walked into the new year like they already read the spoilers.
I love that. Meanwhile, I walked into the new year like, I forgot my password and the recovery email is my 2013 Hotmail. But yes, stocks are up, vibes are up, and my caffeine tolerance is also at record highs.
We've got four big threads: Europe hitting record highs, Hong Kong's IPO dominance rolling forward, two AI chip-related Hong Kong listings, and a personal finance landmine: student loan forgiveness being taxable again for some borrowers in 2026.
Party in the stock market, party in Hong Kong listings, and then the IRS shows up like, nice party. Would be a shame if someone issued you a bill. Let's do it.
Story 1. European stocks started 2026 at all-time highs, tracking global gains. The headline point is simple. Risk appetite came back fast, and commodities-linked sectors like miners reportedly caught a bid as prices rose.
Europe said, new year, new me, and immediately set a personal best. Is this the classic January effect, or is everyone just emotionally hedging their resolutions with index funds?
Finance behind it. When investors feel more confident about growth and rates, they tend to rotate toward equities, especially cyclical areas like industrials and materials. It's basically like the market saying, I'm less afraid of the future, so I'll pay more for earnings.
So the market is a toddler. If it's not scared, it runs faster. If it's scared, it hides under the couch with gold and cash.
Why it matters for normal people. A strong equity tape can lift retirement accounts and workplace pensions, but it also raises the "do I chase this?" question. Actionable move: if you've got a target allocation, say 60-40 or 80-20, check if the rally pushed you off plan and rebalance rather than impulse buying at the top.
Don't celebrate record highs by turning your brokerage app into a confetti cannon. Take the win, tidy the portfolio, and keep your emergency fund from becoming a myth.
Story 2. Hong Kong's IPO dominance in 2025 looks set to carry into the new year. The data point: 114 companies raised about US $37.22 billion on the Hong Kong Exchange main board in 2025, up roughly 229% from about US $11.3 billion the year before, according to LSGE data cited in the report.
That's not a rebound. That's a trampoline. 229% is the kind of number my gym app lies to me about. You improved your fitness by 229%. Sure, Jan.
Simple finance. IPO markets open when investors are willing to fund growth and take liquidity risk. More listings and more dollars raised usually means stronger sentiment, more underwriting activity, and a deeper pipeline of companies seeking public capital.
So Hong Kong is basically the club with the longest line right now. Everyone wants in, but once you're in, you realize the drinks were priced in Hong Kong dollars, and regret is universal.
Why it matters? For investors, it means more China and Asia-linked equity exposure coming to market, and potentially more volatility around lockups, allocations, and post-IPO liquidity. Actionable move. If you invest in IPOs or IPO-adjacent ETFs, set rules: position sizing, max loss, and a time-based review, because hot issuance cycles can reverse quickly.
Yes, because the easiest way to lose money is to buy a story with no seatbelt. If you can't explain how you'll exit, congratulations, you're emotionally married to a ticker.
Story 3. Baidu's AI chip unit, Kunlunxin, filed confidentially for a Hong Kong listing. The key detail is the confidentially applied part. Companies do this to test investor appetite and refine disclosures before going fully public.
Confidential filing is like drafting your breakup text and sending it to your best friend first. Is this too harsh? Also, will the market still like me after I hit send?
Finance behind it. AI chips are a compute bottleneck and a strategic asset. When a chip unit heads toward IPO, it's often about funding CapEx, recruiting, and creating a valuation benchmark, especially in a world where AI can move multiples faster than fundamentals.
So the product is silicon, but the business model is vibes plus capital expenditure. Like, we burn cash, but in a futuristic way.
Why it matters. It signals that the AI supply chain is still a market narrative with real financing behind it. Actionable move for everyday investors. Separate AI beneficiaries into buckets: platforms, chip designers, equipment, and power/utilities, and avoid over-concentrating in the single hottest bucket of the month.
Because if you only own the hottest bucket, you're one headline away from learning what a drawdown feels like in your bones. Diversification is boring, like flossing, but it's cheaper than regret.
Story 4. Biren, a Chinese GPU startup, surged on its Hong Kong debut, opening well above its IPO price and ending the day sharply higher, according to the report. That kind of first-day move tells you demand exceeded the initial supply at the offering price.
First-day pop is the market equivalent of someone yelling, "I'll pay more," at an auction before the auctioneer even finishes the sentence. It's flattering, but it's also chaos.
Simple finance. IPO pricing is a negotiation between the company, underwriters, and investors. A big pop can mean the IPO was conservatively priced to ensure it clears, or that hype outran valuation work. It does not automatically mean the stock is cheap.
Yes, a pop means you missed the sale price, not that you found a bargain. If anything, it's like arriving late and paying surge pricing for a ride you didn't need.
Actionable move. If you're tempted by a debut surge, wait for the post-IPO settling period. Watch volume, insider lockup timelines, and whether the company starts reporting numbers that justify the narrative. Your edge is patience, not speed.
Patience is also free, which is my favorite price. If you need adrenaline, go run stairs. Don't do it with your mortgage payment.
Final story, and it's the one that hits households directly. Student loan forgiveness is taxable again for some borrowers. The report notes that borrowers who get debt canceled in 2026 may face a tax bill, now that the law shielding that relief from federal taxes has expired.
Yes, the congratulations on being forgiven, here's your invoice tradition. It's like getting a coupon that's only valid if you pay full price first.
Simple version. Canceled debt can count as income. Imagine your friend pays off your credit card. Great day, but the tax system may treat that as value you received and ask for its share. That's the tax bomb people talk about.
So you're not paying the loan, but you might owe taxes on the ghost of the loan, like being haunted by Sally Mae, but the ghost works at the IRS.
Actionable checklist. 1. If you expect forgiveness in 2026, estimate the potential taxable amount and your marginal bracket. 2. Increase withholding or make estimated payments so April isn't a crisis. 3. Save documentation, servicer letters, dates, and amounts because the paperwork matters.
And 4, don't spend the "I'm free" money until you confirm you're free. Celebrate with something modest, like a nice sandwich, not like, "I just bought a jet ski because my balance went to zero."
Quick recap. Europe began 2026 at record highs. Good for portfolios, but don't chase. Hong Kong's IPO engine raised about US $37.22 billion in 2025, and the pipeline looks active. Baidu's Kunlunxin filing and Biren's debut pop both underline that AI compute is still pulling capital. And on the home front, student loan forgiveness may be taxable again. Plan now, not later.
My takeaway, the market is doing New Year's fireworks, but your personal finances should do New Year's spreadsheets. One is fun, the other prevents crying in April.
If this helped, subscribe for the daily briefing and share it with someone who wants to invest smarter in 2026. And for your own action today, set a 20-minute timer, rebalance if needed, and if you're in line for loan forgiveness, start a tax buffer fund.
Also, please share with the friend who thinks IPO stands for instant profit opportunity. We love them, but we need to protect them from themselves. See you next episode.